In these problems, we're going to examine the difference in capital structures for companies and what that means in creating what's called operating leverage. In this problem, we have the CVP income statements for Hoffman Company and Tolan Company. Now notice they both have the same amount of sales, $600,000. And they both have the same net income, $150,000 and $150,000. But their cost structure is different. Look at the variable costs of Hoffman. It's $280,000, where for Tolan, it's $80,000. So they have a high variable cost, Hoffman, and a low fixed cost, whereas Tolan has a low variable cost and a high fixed cost. And so therefore we're asked to compute the degree of operating leverage for each company and interpret the results. So we'll start off with Hoffman. Hoffman degree of operating leverage is the contribution margin, which is $320,000, divided by the net income, which is $150,000. And so the degree of operating leverage, or DOL, is equal to 2.133. For Tolan, it has more fixed costs. So when we calculate its degree of operating leverage, we calculate using the contribution margin, $520,000, divided by the net income of $150,000, and we get a degree of operating leverage of 3.467. So Tolan has a higher degree of operating leverage. Its earnings will increase or decrease by a greater amount than Hoffman if each experiences an equal increase in sales. So in B part, they say, now let's assume that there is a 10% increase in sales. What will happen here? All right. Well, we'll do over here Hoffman and over here Tolan. So if the sales increase 10%, then the sales will be $660,000. That is $600,000 times 1.1. And the same sales for Tolan. However, the variable cost will go up 10%. So the variable cost increase for Hoffman would be 10%, 110% of 280, which would be $308,000. For Tolan, it would be 10% increase on the $80,000, which would be $88,000. So therefore, the contribution margin for Hoffman would be $352. For Tolan, it'll be $572. Now we subtract the fixed costs, $170 for Hoffman and $370 for Tolan. And you can see that a 10% increase in price leads to a net income of $182,000 for Hoffman, so it goes up $32,000. However, for Tolan, it has an increase up to $202,000. So it's gone from $150 to $202. It increased by $52,000. The profit increased by $52,000 when the sales increased by 10. But for Hoffman, the profits only increased $32,000. That is because Tolan has a higher degree of operating leverage because it has more fixed cost in its makeup. The second problem. Imogene Arquitectura of Tijuana, Mexico, is contemplating a major change in its cost structure. Currently, all its work is being performed by skilled craftsmen, so it's labor intensive. The owner is considering replacing the craftsman with a computerized drafting system. However, before making the change, he would like to know the consequences of that change, since the volume of business varies significantly from year to year. Now shown below are the cost, volume, profit income statements for each alternative. So you see, sales is the same manual and computerized, but the variable cost manual is quite a bit higher because it's direct labor than it is for computerized, but the fixed cost on computerized considerably higher than the fixed cost under manual. So A, degree of operating leverage. Degree of operating leverage for the manual system then, we'll say it will be the contribution margin of 300 divided by the net income of 240,000, and so the degree of operating leverage for manual is 1.25. For computerized, it would be the contribution margin 900,000 divided by the profit 240,000. So it has a degree of leverage of 3.75, considerably higher than the degree of leverage for manual. So the computerized system will produce profits that are almost 3 times higher than the manual system. With a $1,000 increase in sales, net income will increase 20,000 under the manual system, but 60,000 under the computerized system. And in the next case, we're going to show that. The CVP income statement for man system and computerized, if we increase 100,000, sales goes to 1,600,000. Now the variable cost would increase as well, so we had to figure out what is the variable cost ratio. As it is now, it was 1,200,000 divided by the sales of 1,500,000. It was 80%. So 80% of 1,600,000 would be 1,280,000. For computerized, the variable cost ratio is 40%. And so therefore 40% of 1,600 is 640. So we have the different contribution margins. The fixed cost, 60,000 for manual, 660 for computerized. So you see that the profit for computerized went up to 300,000, whereas the profit for manual was only at 260. So this third part of the question wants to know what would be the margin of safety for them. Well, we know the actual sales, but we don't have the break-even in sales, so we must calculate the break-even in sales. For the manual then, break-even would be the fixed cost, 60,000, divided by the contribution margin ratio. Now that ratio would be 20% because the variable cost ratio for manual was 80%. So the contribution margin ratio would be 20%. And therefore, the break-even would be 300,000 in sales for the manual. For the computer, it would be the fixed cost of 660. Now, the variable cost ratio was 0.4 as it was in the other slide. So the contribution margin ratio would be 0.6 or 60%. And you would get then break-even of 1,100,000, a higher break-even. Now, when you do the margin of safety for manual, it would be the actual sales of 1,500,000 minus the 300 divided by 1,500,000, which would be 0.8 is the margin of safety ratio. And for the computerized, it would be the actual sales 1,500,000 minus the break-even sales of 1,100,000 divided by the actual sales of 1,500,000, and you get 0.27. So you see the margin of safety ratio is quite a bit lower for the computerized because they're taking advantage of leverage. The manual system could weather a greater decline in sales before reaching the break-even point. Under the manual system, sales can drop 80% before suffering a loss, while sales under the computer system can only decline by 27% before suffering a loss. So there you have the advantages and disadvantages of leverage. It works both ways.